What is money and what is banking? And how do the two relate? Well, I think we'll start with a definition of the word money. The only thing that can be money is property. Well, what's property? Property is a set of legal rights. Well, what are legal rights? A legal right is a claim on a use of force by the government. So, for example, when you say, I have a right to my land because I purchased the rights to this land, that means that because you purchased those legal rights, you can call a police officer to remove somebody from your land because property is a right of exclusion, a right to cause the government to use force to ensure that only you control whatever it is in which you hold property. I say in which you hold property because property is not the thing that you're holding. So for example, land is not property. $5 bills are not property. A plow is not property. A t-shirt, despite all the t-shirts that say property of, a t-shirt is not property. Now, you can hold property in a t-shirt, in a plow, in a $5 bill, in land, because property is not the thing. Property is the claim. Property is the legal relation, the legal claim. That's what property is as a matter of law. So you always have property in something. Property in land, property in a t-shirt. In other words, you hold property. And by holding, that's figurative. It means that you have a claim. That's what holding property means. And property is a claim on the use of force by the state to exclude others from controlling whatever it is in which you hold property. Well, are all instances of property money? Well, of course not. You cannot, on a reliable basis, exchange property in your t-shirt for a chocolate bar, for an automobile, for anything. Not even a whole whack of t-shirts. Property in a whole whack of t-shirts you could not reliably exchange for a new automobile at a Chevy dealership. There's something special about the kinds of property that become money. What is it? Well, what makes a given instance of property money is the fact that reliably, and that's key, people will trade virtually every good and service. So we're talking, they'll trade any property or any labor for that property. So for example, central bank notes, whether it's the Federal Reserve, whether it's the Bank of Canada, whether it's the Bank of England, those are central banks, and they publish these pieces of paper with numbers on them, 25, 10, etc. Those are called banknotes, and they're just pieces of paper in which people hold property. Okay? The cash you have in your pocket right now, it's proper to say you hold property in that paper. In particular, the type of property you hold is called ownership. So you hold ownership of the paper in your pocket, those banknotes. Now it turns out that a lot of people will exchange what they have to sell for the property you have in those banknotes, for the ownership of those banknotes. And so I could say to you, listen, I would like to sell you some gasoline if in exchange you give me, the ownership of the $10 note that's in your pocket. I will give to you a certain amount of gasoline at the sticker price that we've got on the board over there. And if you agree, then we would do an exchange. I would give you my property in the gasoline. You would give me your property in the $10 note. Now keep in mind, even if we don't exchange the gasoline and the note, we can still exchange the property because we're just exchanging rights. So I could say, okay, the gasoline's yours, the $10 note in your pocket is mine, and we'll meet here in a year and we'll actually exchange the gasoline for the paper. And that's fine. The fact of the matter is, as soon as that exchange is done, the first one, not the one a year later, but as soon as you've made that agreement, as soon as you agree, okay, now I've got ownership of the $10 note and you've got ownership of the gasoline, it doesn't matter whether you've actually exchanged the physical objects or not. You've exchanged the property rights. You have become the owner of the thing for which you traded your other ownership. And so it turns out that a $10 note issued by your central bank is valuable to almost everyone in your country. And if you're talking about a $10 Federal Reserve note, you'll probably find that it's valuable to people in many other countries as well. Although if you're talking about a $10 Bank of Canada note, it's probably not of too much value to too many people outside of Canada. So keep in mind, a $10 Bank of Canada note is not money, perhaps, in the middle of, the Congo. But it might be valuable to someone near the border in Michigan who regularly shops in Canada. So money is a form of property that reliably can be traded for other property or for labor. Whether that labor is physical or mental doesn't matter. It's services, in other words, goods and services. Once everyone believes that a certain kind of property will be accepted by others, it's money. And so historically we have had, for example, tobacco. Ownership of tobacco was money in North America at one point because so many people wanted ownership of tobacco. Either so they could consume the tobacco themselves, or so they could do a flip and exchange the ownership of the tobacco for the ownership of some gold coins or what have you. We've had gold, coins of gold, that the property in those gold coins was considered money for a good amount of time. Now today, if you have ownership of some gold coins, it's doubtful that people will trade what they have to offer in exchange for ownership of those gold coins because they just don't know how widely those gold coins will be accepted. If they thought that, almost everyone will accept those gold coins as payment in exchange for goods and services, well then they'd probably, accept those coins, and those coins, if they were widely accepted, would be money. But they aren't right now. What do we in society consider money? Property. What is property? Rights. Rights are a claim to the use of force by the state for one's own benefit, and money being a claim on the use of force by the state is exchanged for other claims on the use of force by the state or for labor. That's what we're trading. Money is force, if you want to put it that way. All property is force, and in civilized worlds we trade force for force. We trade control, if you want to put it that way, control over the use of things. At present, in Canada, the United States, Britain, and other industrialized nations, there are really just two kinds of money right now, two kinds of property that qualify as money. The first is ownership of central bank notes and coins. So your ownership of the notes in your pocket, the $5, $10, $20, $50 note in your pocket, your ownership is money. Your ownership of those notes is money. Whether you're in Britain or the United States or Canada, it doesn't matter. The only other kind of property that currently is money is debt. Debt is a form of property that is created when one person borrows money from another. The borrower is called the debtor, and the person lending the money is called the creditor. When the borrower or debtor borrows money from the creditor becomes the holder of a form of property called debt. He holds the debt of the debtor. He holds a debt, which is a claim on the use of state force with respect to the property of the debtor. And if the debtor does not repay the money that was loaned to him, as set out in the terms of the contract, then the creditor, because he holds this form of property called debt, can file a lawsuit, start a claim in the court. Now the claim, as the word would suggest, statement of claim, is a claim on the use of force by the state. Once the judge is convinced that the alleged creditor is in fact a creditor and that he holds a debt of the alleged debtor, the judge will issue a judgment or an order confirming that the creditor is a creditor of the debtor, that the plaintiff is a creditor of the defendant. That order can then be taken by the creditor to the sheriff's office. And the sheriff, once he sees that seal of the judge, okay, will say, oh, that's proof enough for me. And with his, deputies, if you will go to the home of the debtor or to the place of business of the debtor and seize the chattels in which the debtor holds property. The chairs, the desks, the computers, the furniture. He might also cause the debtor to be evicted from his home so that his property in the land can be sold. The sheriff will take that property, put it on the auction block, sell it in exchange for money. So he's selling the property that was held by the debtor, and he wants in exchange money. And then once he has enough money from the sale of those assets of the debtor, the money will be turned over to the creditor, enough, that is, to pay for the outstanding amount owed, plus any interest, plus any costs incurred in trying to collect that money. Now, are all debts money? Turns out, no. Think of a debt like this. And it's Saturday, and you're hungry, and you go to the burger joint, and you have no money. And you say to the guy, I will gladly pay you Tuesday for a burger today. And he agrees. So you take out a piece of paper, and it says, I owe you, $2.50. And you give that piece of paper to the burger maker, who then puts it in his pocket or in his till or what have you. Now he holds a debt, and the evidence of that debt is that note you gave him, that IOU, that note, okay? Do you think it's likely that if he goes to the corner store and wants to buy a chocolate bar and a pop, that he'll be able to exchange your little IOU for that pop and chocolate bar? Well, I guess there's a small chance that maybe the person who runs the store is your mom, and she knows that if you issue that IOU, you're good for it. Most people don't know who most other people are, and they certainly don't know how many people will be willing to accept your IOU. So the ownership of most IOUs is not money. Are all IOUs worthless? Nope. There are some persons who issue IOUs all the time that are widely honored by just about everybody in exchange for goods and services. Those are the IOUs issued by banks, chartered banks. Well, why are people willing to accept an IOU issued by a bank? And I've never seen an IOU issued by a bank before. What are you talking about, McKeever? Well, open up your bank book or your latest bank statement. You'll see a number there. I'm talking about your bank balance. That bank balance is a number that indicates how much money the bank owes to you. And it's money of a particular kind. It really indicates the total currency that must be paid to you. In other words, if you have a bank balance of $100, that means that you have a right to go into the bank and make a claim for banknotes equaling a denomination of $100. So, $10 notes or $25 notes or what have you. Now, that's what that bank balance means. You don't have to take it out as notes, but if you demand notes, the bank has to pay. That's what that balance means. Now keep in mind, a bank has thousands or millions of accounts held by people all over your country, and everyone believes, for whatever reason, that the banks will, if asked to, honor their debts, and they will pay the cash, the banknotes that are demanded by their depositors. And so people say, well, look, I don't require you to go to the bank and have the bank give you banknotes simply so that you can pay me banknotes in exchange for my goods or services. I'll tell you what, just tell the bank to reduce your balance and increase my balance, so that the bank will have to give me more notes if I go in and ask for them, and they'll have to give you fewer notes if you go in and ask for them. Well, how do you tell the bank to change one guy's balance in downward direction and change another guy's balance in an upward direction? Well, with a thing called a check. The person who wants his balance to decrease takes out a piece of paper that says paid to the order of, and fills in the name of the person whose balance is to increase, and then fills in an amount by which his own account is to be decreased and the other person's account is to be increased, and then he signs that. He gives it to the person whose account is to be increased, and that person then takes it to the bank. The bank reads the check and says, oh, we're supposed to decrease the first guy's balance by this amount and increase this guy's balance by that amount. Same amount. Okay, and they do it, assuming they believe that check was really issued by the person having the bank account, etc. So a check is an instruction to the bank telling them to lower one person's balance and increase another person's balance. In other words, to decrease the amount that they owe to one person and to increase the amount that they owe to another person. Well, what are we transferring when we're transferring money in that way? Well, we're transferring debt. One guy who wanted to buy a burger knew that the bank owed him money. And so he knew that he held a debt of the bank. And so he decided that rather than going to the bank and getting the bank to honor the debt and pay cash in exchange for the debt that he held, he thought, no, I'll just transfer some of this debt over to the guy who makes the burgers. And so he issued the check, gave the check to the burger guy. The burger guy goes to his bank. The bank reads the check, lowers the balance of the guy who just bought the burger, and increases the balance of the guy who just sold the burger. And that's it. So what just happened? The person who wanted the burger exchanged debt, bank debt, for the burger. The debt, when it's bank debt, when it's a debt of the bank, when it's money owed by the bank, when it's an IOU issued by the bank, and that balance is an IOU, that's widely regarded as an IOU that reliably will be accepted by most people in exchange for goods and services. Bank credit is money. Your credit is not. A bank's IOUs are money. Your IOUs are not.